Hi guys, let's talk about a subject no one has talked ever before. It's about China. Okay, the Chinese stock market is a little bit in trouble. We will talk about why, and I will show you what kind of investors could now feel happy about an buying opportunity. Because China has something to offer not only for growth investors, I will say Tencent, Alibaba, and the like, and we will look about the valuation and the chances of Alibaba and Tencent very soon from a fundamental point of view. But there's also some interesting for dividend investors, for dividend income investors and growth investors. But I think for dividend income investors, especially, there are really high yield dividend stocks in China waiting for investors who want to diversify their portfolio and which are keen or brave enough to invest in this country. Before you do so, let's talk about some survival guides. So I will show you some rules you should better follow to minimize your risk. And before we do so, just let's talk about the current problems from a high-level point of view. My name, by the way, is Thorsten, and I'm the founder of this website, Dividend Stocks Cash. What are the problems related to China? They are twofolded. Once we have political problems, you know, the trade ban of Chinese stocks, of companies which are affiliated somehow to the Communist Party, to the government, to the Chinese military. And on the other hand, we have the delisting, or additionally political tensions, menace of delisting of ADRs in the United States. It's not imminent, but it could come, could get a subject within the next 2-3 years. And then we have another set of problems, which is the regulation within China itself, done by the Communist Party. And this is what causes most of the current sell-off. If you want to invest in China, there are some rules of thumb to follow to minimize your risk. It's what I call the survival guide. First, I suggest don't buy ADRs if you don't have to. Either you can, if you are lucky enough, the company might have a double listing, like Alibaba, for example. They are also listed in Hong Kong. Then better buy the stock in Hong Kong instead of the ADR, which could get problems when being delisted. And trade should still be possible over the counter, but it's better if you don't have to deal with such a potential problem. If you have two stocks, two companies you might invest in, one with an ADR and the other one is not, then choose the stock which is not an ADR. Why? Because ADR means that the IPO was done in the United States, and I think Chinese government doesn't respect the money of citizens from the Western countries as much as money of Chinese people. So if you have two stocks, one is two companies, one has its stock listed in the United States and the other one in China, then this would be an argument to opt for the China company, which is not listed as an ADR. And another point, choose stocks with a long fundamental history. They are much better to evaluate than new stocks. Especially be careful with IPOs of Chinese stocks, and take a look also for high market capitalization. This goes in the same direction for Chinese blue chips, for example. We will see some later, instead of very small companies which are much easier, where it's much easier to cheat. Then pay attention that there's low risk of conflict, low potential of conflict with the Chinese Communist Party. This is an indicator for that, could be the ownership. So if the ownership is, if the Chinese party or the government itself holds its stake on the company, or if an affiliate administration or institution of the Chinese government is a stakeholder, then this is an indication that there's low risk of potential with the Chinese Communist Party. Another point which is important, prefer companies doing much of the revenue outside the United States, mostly inside China itself, if possible. Take a look at Huawei. So sanctions or a complete sanction ban or whatever, you can't, the United States, for example, can't cut off a company which doesn't make revenues in the United States. It's a logical point of view, I think. So they are less harmful from political tensions. They can still be harmed. We have logistical problems in the global economy, but that's always the case. Okay, these were some points I called a survival guide. If you want to invest in China, you could respect these, and if you do so, it might pay off. Now let's have a look at some of the companies, and I said right at the start, there are two kinds, or they are not only growth stocks, it's the stocks which lose the most, mostly. It's which stocks lose the most? It's Chinese ADRs, mostly, and it's growth stocks, mostly, with not a very long history, and yeah, just take a look at it. Instead of just talking, showing is the better way. Okay, so this is dividend stocks cash, and this is our screener here. And first, I want to empty the filter, and then we select only companies from China, the motherland, or from Hong Kong also. And then we have the stocks here. These are only stocks either listed in China itself or listed in Hong Kong. And we have now the growth stocks. And then we can take a look, for example, at Alibaba here and at Tencent. And I will just analyze these two in a short way. And let's start with Alibaba. We also have other growth stocks. Also what we can do here is, for example, I reset the ranking here. And if you are really keen only to get really high quality stocks from a fundamental point of view, then add the earning stability as a criteria, for example. Already minimized our list essentially. This means that the reported earnings evolved in a very stable way within the last decades, if the company is listed so long, otherwise within the last years available. And here is the ranking, and the ranking manipulates this column here. And we can say, okay, we now want to get companies which increase their earnings in a very stable way, in the most stable way possible, like a ruler, and very aggressively, 20%, the same for the operating cash flow, for example. Let's see here, revenues should also increase very in a stable manner, and also very fast, 20% compound annual growth rate. This is really aggressive, and if you apply that, you see that the ranking here, that it will change very soon. Then we can just sort by this column, and the growth rockets, they are here now right on the top. Where is Tencent? Where is Alibaba? Here is Tencent, here's Alibaba. They still have lot of points, very good scoring with more than 90, 91 Alibaba, Tencent 94. Others even better, most probably companies you never heard of, like Wuxi Biologies. What's that? And how does it look like? If I say the earnings grow, and it looks like that. Here you see the growing revenues, but here they are not listed very long ago. I want you to show Alibaba and Tencent. Here is Tencent, for example, At the start, I said we start with Alibaba. Now we start with Tencent. Okay, take a look at Tencent. And what's most interesting is the valuation here. Tencent and Alibaba, they are both affected by regulations. Alibaba, in my point of view, is hit harder and is more vulnerable than Tencent. Tencent has a very broad business model. They have a lot of cash flows, a lot of cash cows. You should also be able to see it here in the segments. Not really. Alibaba has more segments, but if you look at the presentation from Tencent, then you see that they've built a complete ecosystem ranging from online games to payments to music, all kind of entertainment, online advertising, all that stuff. And Alibaba basically only earns money with the online merchandising, with e-commerce. And otherwise, they lose money with all our segments. And this makes them much more vulnerable, in my point of view, than Tencent is. Tencent pays dividends. Alibaba does not. And you might say, hey, dividends are so low right now from Tencent, 0.36%. But Tencent is going to increase very aggressively its dividends. They have a dividend growth of about 30% in the long run. 30% dividend growth each year, which means that if you look at the dividend benchmark here, looks like that. This is your personal dividend yield, 0.4% at the end of 2021. Right now it's 0.3 something. We just seen that. And then you see how the dividends increase. And if you just stay long enough, then your dividend yield could be double digit if the Communist Party agrees with that. Okay, take a look at the valuation, and I think this is very interesting. We use the adjusted earnings and the reported earnings. Cash flows we could also use, but we don't. Dividends we don't, because dividends are too low right now. You won't buy Tencent because of its high dividend or because of its dividend in general. And you see here that right now we have price earnings based on adjusted earnings of below 30, which is less than the average valuation within the last 10 years. The last 10 years is this marked by this blue background. We could also take another period for the calculation of the average multiple here. But I think that's already okay. It won't change anything. I already see that. If I start from 2008, it won't change much. Yeah, you see. Okay, right now we show the fair values for Tencent, and then we zoom in a little bit, even more, and you see here the earnings growth, which is updated daily based on the data, the consensus estimate, and collected data from FactSet, our first data provider. And then you see that thanks to growing earnings, then that the fair values also grow. Right now, fair value based on the current business year is about 550 Hong Kong dollar. Current stock price is well below, around 450 Hong Kong dollar, which means upside potential, short-term upside potential of 23% within only about 5 months. And if you look at the medium-term potential here, based on the estimate of the year 24, its annual yield of 26% or 125% dividends included overall. And that's pretty much what we can see here is kind of backtest that Tencent was 2 times overvalued, once in 2018 and once right at the start of 21. And now there was this phase of when the stock price came down. We all know it. So now is the problem, is it true what analysts expect here? Does it still hold true because of the regulations? Regarding Tencent, I'm rather optimistic. I'd say I think Chinese Communist Party hates Alibaba much more because of its founder than I think Pony Ma is not someone they really hate. And it always might be a little a personal thing. Although I think that the Chinese Communist Party in Xi Jinping, they really know what they want and they are not as easy influenceable by their moods. So don't take this too serious what I said right now. Okay, but we can see from a fundamental point of view, Tencent looks really not super cheap, but very attractively priced right now. Of course, no one knows how long the sell-off of Chinese stocks will continue. But right now, if you don't own Tencent and you are brave enough, then you could start to build up a position. For example, let's look at Alibaba, which is an ADR. I just warned you, but they also have a listing in Hong Kong, and what I wanted to show you is that here they lose money with anything except the e-commerce. For example, the cloud computing and digital media and entertainment, these are there's a high deficit. And you can also even see the margins here, by the way. I don't know if Tencent also offers margins. Yeah, they do. And you see that all segments here are highly profitable value-added services, fintech, and online advertising with operating margins above 50% for value-added services and online advertising, while Alibaba, if you take a look here, commerce, they don't offer margins for everything. For commerce, they don't, but they earn a lot of money with that. But for cloud computing, margin is minus 18% and digital media minus 55%. So you see what I mean. And because of that, they are more vulnerable. If we look at the valuation here, then also we use the adjusted earnings. They don't pay dividends. And here you see that they have a slight decrease of earnings, but they should continue to grow their earnings. There might be also the fine included of 2.7 billion, I guess, something like that. And they have an adjusted price earnings of below 20, 90.2, which means that Tencent is more expensive. They are just right below 30, and they are just right below 20. And I guess that the market also sees higher risk from these regulations for Alibaba than for Tencent. If we look at the valuation, we show the fair values here, then you even see that Alibaba looks even more undervalued, short potential of 36%. And Tencent, you remember, did you pay attention? What was it for Tencent? I think somewhere below 30. And for in the midterm, we have annual yield of 32%. I think that's even, is it higher than for Tencent? Just look back if you want to compare. I don't remember. But what I remember is that I think that the risk for Alibaba is higher. If you sell stock options, for example, then you can get a nice prime for Alibaba. Okay, so this is Alibaba and Tencent, and you saw that from a fundamental point of view, both look attractively valued. I would prefer Tencent. But then we also have other stocks. We have these dividend stocks, and Chinese dividend stocks aren't in focus of many investors. I will show you that first I will show you that we have partly nice dividend yields of Chinese stocks, and remember we already filtered for quality stocks here. So we have dividend yields of up to 9.5%, 8%, and so on. So these are attractive dividend yields. I turn off the filter. I want to show you that we have even much more, or many more. Sorry, now I have Russian stocks and so on. Okay, turn on the filter, turn off that one. So, and we can add a ranking, for example, the dividend income ranking, and then this makes sense for dividend income investors. And now you see the dividend yield here of different stocks like China, resource, cement, and very often we have the phenomenon or situation right now that the current dividend yield is well above the dividend yield in the past. So the relative dividend yield or the current dividend yield is really high without these companies having special problems. And this is the Bank of China, for example. Let's look at the current dividend yield with 8.6% is also close to all-time high. Or take a look at Everbright Environment. You see the very same. Current dividend yield is absolutely on all-time high. China Mobile, for example, telecommunication stock. This was special dividends, but if you exclude special dividends, also 6.8%, 9% even, very close to all-time high, and so on. We can also see that the dividend yields of Chinese stocks are really high, even compared to themselves. If we sort by the column fair value dividend, if these metrics here are negative, and if you see the dollar sign here, then they are undervalued. We have 4 different columns for fair values. This is just an indication if the company or the stock of the company is over or undervalued based on different metrics like cash flow, earnings, and this one takes dividends into account. Let's sort by that one. And no, that was wrong. Now we have the non-dividend payers. Let's get rid of these. We want at least dividend yield. Any dividend yield will do so. And now all these companies shine with an extremely high dividend compared to what the average dividend yield of the company was in the past. We have some where the current dividend yield is really low, but most of them have a high dividend yield. So, yeah, okay. It's not all of them, but some of them. It's about 50%, I'd say. And there might be some chances. For example, this is CRRC Corporation. And CRRC Corporation, if you look at the fundamentals here, okay, operating cash flow, free cash flow, not that good, but reported earnings, very good. And this is the largest train manufacturer in the world. And their valuation is cheap. Well, let's look at the dividends first. You see that they have really high dividends, all-time high with 6.5%. And I own the stock, by the way. I also own Alibaba and Tencent as a little disclaimer. And if you look at the valuation, then you see that the stock price made some miracles, but then it came down, and the stock price right now with 2.8 renminbi is below what the stock cost back in 2008, for example. So it's not an earnings rocket, but if we look at the adjusted earnings, then you see that they take the right direction. The current price earnings based on adjusted earnings is just 6, which is really cheap, or at least it looks very cheap. And if you look here at the historic valuation, then we can also see that the stock looks really cheap. I think that we could adjust the price earnings of 14. It might be a little bit too high because somewhat might have changed here, and we won't see 14 very soon, but we can limited to 10, which is much lower than the stock was valued in the past, but still well above what the current stock price is. And if you look at the short-term upside potential, it is 50%. And because the company doesn't increase its earnings very aggressively, in the long run it goes down, but the annual yield in the midterm is still 30%. Some part of it is dividends. It's just about a fourth or a fifth is dividends, and the rest is capital gains. And it's the largest train manufacturer in the world. And here, for example, with Ping An, we have the largest insurance company in the world. If we don't take into account Berkshire Hathaway as an insurance company, as far as I know. And here you see that these highly digitized and fintech-like insurer offers a dividend yield of close to 4%, and it was never matched before. Before we had dividend yields of well below 2%. Just starting in 2018, the dividends climbed a little bit higher, but now they're even higher, with close to 4%. And if you look at the valuation, for example, then you can see that they nicely increase their earnings. They increase their earnings with double digits within a year. On average, for the last 5 years, reported earnings grew by 20%, and the revenues, for example, grew by 10%. And the stock price right now is here 65 Hong Kong dollar, which is somewhere the stock price was back in autumn 2017, while the earnings grew nicely from less than 6 Hong Kong dollar to probably estimated close to 10 Hong Kong dollar. And the current price earnings based on adjusted earnings, they are right below 9, and the average was 12.6. So if we show the adjusted, the fair value based on the adjusted earnings, and you see that it really looks crazy, the undervaluation here. The stock should be fairly valued at 127 Hong Kong dollar, which looks a little bit too optimistic based on price earnings of 12.6, because I'd say maybe I don't think that we will see this all-time high within this short period of time. We should most probably lower the multiple to calculate the fair value to 10, maybe to 10, and then also the back test I think looks nice, or even to 9. Let's go to 9, and now we evaluate the stock rather defensively, I'd say. And then we can zoom in here. This is the current stock price. Now the earnings potential would still be 40% within 5 months, which is really a lot. It is only theoretical a little bit, as long as the mood remains as bad as it is, and especially if the Chinese stock sell-off continues, then this won't become true. But in the medium and long term, the real earnings, these are they will decide where the stock price is going in the medium and long run. And you will see here that the annual yield within the next 2.5 years would be 33%. It's about the same as for Tencent and Alibaba, somewhere the same level, with an insurance company with price earnings of below 9 and dividend yield of close to 4%. You can add these valuation lines here and say this is still too optimistic for me with price earnings of 9. I don't think that the stock price will go up like that. I think it will go, but it might go up somewhere close to 100 Hong Kong dollar, and then you still have an annual yield expectation of 22%. And I think this could be attractive for investors not keen enough to invest in Chinese stocks. So China has something to offer for growth investors, I think this we all know, but also for dividend investors. And they really have a lot of dividend stocks with mostly high dividend yields, and many of these stocks have dividend yields, we see it here, on all-time high. Not all, okay, but many of these are stocks with an all-time high. Okay, that was my little video about Chinese stocks. I hope you liked, and see you next time on whatever subject it will be. Ciao.